Is 2023 the year that value investors gave up on Alibaba?
I regard Alibaba as one of the worst mistakes I ever made.
Well, maybe. The stock price is down significantly this year, even though the market is up. And that's not even the worst news. The dream that Alibaba's parts might be a greater sum than its whole is also dead, as the company has cancelled its plans to IPO and spin off its cloud division. The late Charlie Munger, rest in peace, regarded Alibaba as being his worst ever investment decision, and I'm beginning to agree with that sentiment. I'm currently down nearly 50% on the stock, and at face value it looks like it has a great valuation, but I do think there's more to be said about the stock than the valuation itself. So let's go through all of the recent news with Alibaba with regards to the earnings and other concerns surrounding the stock.
Shares are down more than 9% after nixing its planned cloud spinoff, and it cited U.S. chip restrictions. Now, more broadly, it throws cold water on Alibaba's shakeup to spin off all 6 business units, and it also shines a spotlight on how far Alibaba has fallen. A market cap of more than $800 billion at its peak to now just over $200 billion. Much of that has been attributed to the Chinese government's crackdown on tech, but there's cracks in the fundamentals too.
Starting with earnings, Alibaba met its revenue expectations of around 9% growth, but actually missed out on its profit expectations, coming in below expectations. The CEO of Alibaba pointed towards the company's growing cash pile. It's currently sitting at around $60 billion, nearly half of the company's market cap in cash alone, as being a sign that investors can be confident in the future trajectory of Alibaba. Now, I personally view that growing cash pile as a weakness, not a strength, in the way that the Alibaba CEO does. Any major Western company, if they were sitting at the kind of valuation that Alibaba is, would be funneling money into doing share buybacks, at least if they think that the company is undervalued currently, as that provides great value to shareholders. Alibaba is currently sitting at 8 times forward earnings, and it would be an absolute steal at this price if the CEO had confidence in the company's trajectory. But clearly that isn't the case, or there is another factor going on behind the scenes. The company always points towards its large buyback authorization amount of around $25 billion, but the reality is that the company does not use anywhere near that amount to buy back shares. In fact, last quarter the company spent around $1.7 billion on buying back shares, which amounted to being around 0.7% of the total, for an annual rate of around 2.8% buybacks per year. And if you compare that to a company like Meta, which when its price collapsed last year, it was buying back shares at a rate of around 5% per annum. Meta's total share count went down by around 5% year on year, even though they offer generous share-based compensation to its employees, which would cause the share count to go up somewhat. But with Alibaba, when you take into account stock-based compensation, the number of shares per year went down by a lot less than 2.8% because of this compensation. In fact, the company spent around $28 billion over the last 11 quarters, but only reduced its total share count by around 6.8%. That's a lot less. With its cash pile growing every single quarter, some investors might be pleased to hear that Alibaba has announced its first ever dividend. With a yield of around 0.9%, it's not too bad, but I personally think that this is a massive mistake. I think that companies should only issue dividends when they have nothing else to put their money into. If they can't reinvest into a better part of its business, or it can't offer share buybacks because the share price is so high, that's when it should be doing dividends. But when you look at the Alibaba share price, clearly it's sitting at very low valuations, and stock buybacks would be a much better option here. Failing that, you should at least reinvest into some of the growth areas of the business. If it's obvious to me, then it should be obvious to any competent CEO that the time for a dividend is not now. So that concerns me. Not necessarily the competence of the Alibaba board, but potentially the intent. Now, it's always been a concern with Chinese companies that companies aren't run in the same way as American or Western companies. Companies in general should be run for the profit of shareholders and the best interests of shareholders. But Chinese companies have a very different legal and political system, and we've seen with Jack Ma already that the CCP doesn't necessarily agree with the shareholder first approach. Whilst I am worried about CCP interference in the direction of the company, I'm more concerned that the leadership has completely decided to U-turn on its previous plan to break the company down into its separate parts and IPO each one and turn Alibaba into more of a holding company. That previously caused the stock price to spike, and now on news that the company is cancelling those plans, it's gone back down. Now, it's not necessarily the idea being cancelled itself, it's more of the fact that the company seems to be in absolute chaos. No normal company would announce major plans like that and then cancel them within a few months.
Other Chinese companies, they may have played the chip ban better. Yesterday, Tencent said that it had a large stockpile of AI chips from NVIDIA, which it'll use more efficiency while looking for domestic alternatives.
One of the main reasons for Alibaba cancelling its cloud division spin-off was geopolitical. The US ban on AI chip exports to China has really weighed upon China's AI and cloud industry, which doesn't have access to the latest chips. But that doesn't explain all of it. The cloud division at Alibaba is actually growing at an extremely low rate and losing market share to its competitors. The revenue at the cloud division increased by only 2% last year compared to 50% in the years prior, so a significant decrease in growth. And that brings me back to Charlie Munger's reasoning for why Alibaba was his worst ever investment mistake.
I regard Alibaba as one of the worst mistakes I ever made. In thinking about Alibaba, I got charmed with the idea of their position on the Chinese internet. I didn't stop to realize they're still a goddamn retailer. It's going to be a competitive business, the internet. It's not going to be a cakewalk for everybody.
He said that when he invested into Alibaba, he did it based on valuation, but forgot that the company is a retailer and it's in an extremely competitive environment. I think it's really easy to focus on the valuation and realize that Alibaba's competition might actually be beating the company into the point where it's no longer a growth stock and is declining. And there are signs that the competition in the e-commerce market, which has been very lucrative for Alibaba, is also heating up and starting to hurt the company's profits. If you look at PDD, a rival firm that runs the website Temu, that's become extremely popular internationally and had sales growth of over 100% year on year, it is taking market share away from Alibaba. In addition to that, other rivals like TikTok and ByteDance are also eating into the e-commerce market as well. Even Alibaba's employees are panicking. Many of them took to its internal forum to comment about PDD and say that the company was about to overtake them anytime soon. Jack Ma, the company's founder, actually had to take to the forums to respond to some of these users to try and assuage their fears and also issue a rallying cry for the company to reform and eventually return back to its roots of growth. Many of the employees expressed concern about the direction of the company, not just the growth rates. For example, they wondered why the company was going to split off its cloud unit and many other divisions, but then did a complete U-turn. They didn't know what the direction of the company would be in the future regarding this, and that is concerning for me. If there's complete chaos internally, how can the company do well in the long term? Jack Ma himself, even though he was issuing a rallying cry, he is actually looking to sell around $800 million worth of the stock. Meanwhile, on the macro level, it's not looking good either. China is facing a number of economic pressures, including deflation, issues with the stock market, and property developers defaulting on their debts. So the Chinese consumer may not have growing amounts of money to spend for a long time yet. In fact, the Hong Kong Stock Exchange, the Hang Seng, has been down for 4 years straight, which is pretty abysmal. Even though Alibaba sits at a great valuation, there's no guarantee that the price will go up because none of the problems have any immediate solutions, the ones that I've mentioned previously, nor is there any liquidity in the Chinese market to buy up these depressed valuation stocks. When I actually compare Alibaba to one of my other holdings, Crocs, which I've bought largely on valuation as well as other factors, I way prefer Crocs and have a lot more confidence in the future of this stock. Whilst Crocs and Alibaba are trading at very similar valuations, around 10 price to earnings ratios, Alibaba has far more risk politically from the fact that it's based in China, whereas Crocs has essentially zero. It's a bog standard American company who can be trusted to put the shareholder first, and I do think that has a lot of value to it. In addition to that, Crocs has a much clearer runway for growth ahead of it, whereas Alibaba has all of these hurdles, including regulatory, macroeconomic wise, and so on. So I actually am thinking of putting more money into Crocs and potentially reducing my position in Alibaba within the next year. I potentially will hold on for a while to see if the situation improves, but right now I don't really see any signs that it's going to improve. So let me know what you guys think about Alibaba, whether you've considered selling, and let me know if you enjoyed the video, and I'll see you guys next time.